Imagine there's a ridiculously simple trading method that could earn you hundreds of dollars daily in Forex trading. The best part, you only need to capture 20 pips. Let's look at Euro USD on a 15-minute chart. Here are the profits I recently achieved with this strategy. Before we dive into how to pinpoint entries and exits for those 20 pips, it's crucial to address something vital in Forex trading: the relationship between your account size and pip value, and how these work together to shape your trading approach, especially when aiming for 20 pips daily. Let's first discuss account size. Whether you're starting with $100, $1,000, or even $10,000, your account size significantly impacts how you should approach these 20 pips, because at the core, successful trading revolves around managing risk effectively. For instance, if you risk 2% of your account per trade, the potential loss varies widely based on your total balance. This means a $100 account might risk $2, a $1,000 account risks $20, and a $10,000 account risks $200. When targeting profits, aim for at least twice your risk. If you risk 2% of your account, set your profit target at 4%. In practical terms, risking $2 on a $100 account means aiming for $4. Similarly, risking $20 on a $1,000 account should aim for a $40 profit, and for a $10,000 account, risking $200 translates to a $400 profit target. This 1.2 risk to reward ratio ensures that the strategy remains both sustainable and focused on long-term growth. To achieve this, another critical element to consider is the lot size for your trades. That's where this handy calculator from forextime.com comes in. Start by entering the number of pips you're targeting. In this case, 20 pips. Select your currency pair, e.g. EUR/USD, and adjust the trade size in lots until the calculator shows your desired profit amount. If needed, tweak the lot size to hit the mark. It's that straightforward. Input your values, make adjustments as needed, and the calculator provides the exact profit and lot size to use. Now that we've set our numbers, let's move on to the strategy itself. We'll use two indicators: the Chaikin Money Flow, CMF, and the 100-period moving average for confirmation. To add these, go to the Indicators tab, type CMF, and select the first option. The CMF appears as a line oscillating above and below zero, indicating market buying and selling pressure. Next, add the 100-period moving average by typing moving average and adjusting its length to 100. Now, you might wonder how these indicators help capture those 20 pips consistently. The Chaikin Money Flow measures money flow into and out of a currency pair, reflecting market buying and selling pressure over a specific period, usually 20 or 21 days. For example, if you're targeting an upward move of 20 pips, look for the CMF to cross above zero. This indicates strong buying pressure as money flows into the market. To confirm, ensure the price is also above the moving average, signaling an uptrend. For sell opportunities, look for the CMF to dip below zero, indicating increased selling pressure as money leaves the market. Additionally, make sure the price is below the 100-period moving average to confirm a downtrend. Let's explore an example. In this Euro USD 15-minute chart, the overall market trend is bearish. On the 1-hour chart, the price consistently forms lower highs and lower lows. Narrowing down to the 15-minute chart, the price is below the moving average, reinforcing the bearish outlook. At one point, the price consolidated into what I call a squeeze triangle pattern, showing indecision. However, as the CMF started dropping, two consecutive bearish candlesticks broke the support line of the triangle. Recognizing the bearish market direction, I anticipated a retest of the previous low. For this trade, my stop loss was 10 pips and my profit target was 20 pips. The price followed through as expected, hitting the target and earning me a $200 profit. Now let's consider a bullish example. In this scenario, the price was trending upward, staying above the moving average, while the CMF crossed above zero, signaling increased buying pressure. My stop loss was placed just below the moving average, and my target was set at 20 pips. The trade climbed as predicted, reacting to a previous high before pushing past it and reaching the profit target. If you found this video helpful or learned something new, let me know in the comments below. And if you'd like to join my VIP trading community where we dominate the markets every week, you'll find the link in the description.